My name is Tim Pickering. I'm President and CEO of Auspice Capital Advisors. We are a commodity fund manager based out of Calgary. My background prior to starting Auspice, I was VP of Trading for Shell. We trade everything. We trade 7 sectors from energies, grains, softs, metals, right into the financial futures, pretty much cover the entire marketplace. What we're looking at is an overall trend definition. We're looking at the market is going up or going down, and then we're trying to add things to that trend definition to ensure that the market's going to continue to go in that way. The most important thing is identifying when the risk reward of that trend changes, that we take our money off the table. We either reduce our position size or we get out of the market completely. So we're looking at volatility, we're looking at historical pricing, we're looking at other cues in the marketplace to identify when that risk reward changes. The core strategy contains a couple elements. In terms of trend following, we identify a trend and we identify the market's going up or down, and then you're doing things to identify if the market's going to continue to go in that direction. From that point, what you're doing is you're trying to extract value and keep those mark-to-market gains as quickly and efficiently as you can. For us, this is what we call trend capture. It's identifying in the market when that trend is turning or the risk reward of staying in that trade has changed. It's also the way that we're able to employ a lot less capital into the market, and why we run a very low margin to equity, because we're into the market, we identify when the risk changes, and we come out of the market efficiently. Our overall strategy is an adaptive strategy, so we use a single strategy that is allowed to adapt organically to the market condition. We learned this early, that you can't trade a commodity like natural gas the same at 30 volatility as 130 volatility. They're two different things. So your strategy has to adapt to the market environment, your risk management has to adapt to the market environment, and we're aiming to do that across all the markets that we trade. Systematic trading is not something that should be shied away from. We've taken all of our experience, we've put it together, we've embraced technology, and the key reason is so we can employ that strategy consistently. I flew here on an airplane this morning, and I'd be worried if the pilot wasn't doing things in a very non-discretionary, consistent way. And what we're trying to do is approach the markets in the same way, that we approach them consistently, rigorously, and that enables us to articulate our risks very well. The beauty of systematic trading and quantitative trading is we can articulate our risks very well. We go way beyond the traditional VAR-based approaches, use Monte Carlo simulation and other methods to understand what is the range of outcomes we could have, what is the range of good outcomes, and what is the range of bad outcomes, what are the drawdowns that we could have. And we're able to articulate those upside risks, or upside opportunities, as well as downside risks very succinctly. And it's something that the discretionary trading community has a lot of trouble doing, is identifying what are those downside risks and articulating those things. So it's a key advantage for us as non-discretionary traders and for the investor in the CTA space. We can take that strategy and employ it across many markets globally. The markets don't have to be the same. We trade natural gas, we may trade lumber. They're very different markets, but they have key things that are the same. We approach the risk management the same, and the futures market and the liquidity of the futures market enable us to approach those many markets across the globe consistently in a very efficient and low-risk way. At Auspice, we like to focus on what is happening in the market, not what we believe should be happening in the market. The reality is that the market is going somewhere. It's going up or it's going down, and we aim to extract value from the market in some capacity without trying to decide why the market is going that way, but just accepting it and managing the risk appropriately. Risk-adjusted return is considering the return that you make over time versus the drawdown or the risk you took to get it. It's nice to say that you'll make a 10% annualized return. The question is, what do you give back from time to make that return? we aim to balance those two factors. I'm not going to try to make a 10% return and risk 30 or 40% to get it. So we're balancing the return with the drawdown and the risk we take to get it. I don't think buy and hold in the traditional equity, long, short, and private equity hedge fund strategies are dead. I think what you have to do is recognize what happened in 2008. A lot of those strategies became too big for the market condition. And one of the hallmarks of what we do, what a lot of CTAs do, is adapt to the market condition. Adapt to what the volatility and the market risk is telling you. If the market is getting risky and volatile, cut your positions. Have a position side that's applicable for the market condition, and that is the hallmark of our risk management and capital allocation backbone. It's also one of the failures of the traditional hedge fund community, is to adapt to the market condition. We saw this in 2008. Futures markets, while obviously are liquid, they provide consistent returns and consistent volatility. The risk in trading equity to find trends is that news reports can come out, the markets can gap, and we can't control our risk appropriately when markets do that. That's a hallmark of the equity business. On the futures side, the liquidity and the depth of the markets provide consistent price action, consistent volatility that we can then manage for our client base. Research is a consistent part of what we do. It's ongoing. The markets are changing, the markets are evolving. So we're always looking for better ways to not so much provide returns, but to manage the risk. Is there a better way to control our downside? The futures markets provide such an enormous amount of information, data, right down to the tick level. And the CME Group is so instrumental in providing that data. This is really what makes our job a lot easier in terms of articulating and researching our strategies. CME Group products make sense on a number of levels. They're liquid, they're efficient, the electronic trading aspect is a game changer in the trading business. The improvement in electronic trading and execution has improved so dramatically in the last 5 years. Really makes our job a lot easier in terms of managing risk. I think one of the problems in the CTA space is that the CTA community has been very focused on single strategies, and that is the basis for their business. And when an investor, especially at the institutional level, comes along and they look at the business risk of investing with that fund manager, there's a lot of risk on that particular strategy. If it works, if it doesn't, if it provides the right return. At Auspice, we set out to reduce that business risk by having multiple business lines, diversified revenue streams that then again lowers the business risk of an investor, especially at the institutional level, in investing in Auspice as a business.